There's a specific dollar amount buried in federal law, and the moment your bank account crosses it, a report gets filed automatically with a federal agency. No letter, no warning, no call from your bank. It just happens quietly. But the real danger isn't the report itself. It's the instinct most people act on the moment they learn this number exists, because that safe move is actually a federal crime. I'm Lana Maines, and every week I make videos to help people understand the money rules nobody ever explains to them. What is the number? Under the Bank Secrecy Act of 1970, every U.S. bank, credit union, and savings institution is legally required to file a report with FinCEN, the Financial Crimes Enforcement Network, whenever a customer makes a cash transaction over $10,000 in a single day. This is called a Currency Transaction Report, Form 104, and it includes your full name, social security number, date of birth, address, and the exact time of the transaction. Banks have 15 days to file it, and by law, they cannot tell you it happened. This rule is only about cash. It applies to physical cash and cash-like instruments, like money orders, not regular checks, wire transfers, or direct deposits, such as Social Security. But there's a catch. If you make several smaller cash deposits at different branches on the same day that add up to more than $10,000, the bank still counts them together. Splitting locations doesn't get around the rule. Both types of retirees are at risk. Retirees with modest income often assume they're safe because their deposits rarely get close to $10,000. But that's not necessarily true. Retirees with more savings face risk from pensions, inheritances, or consolidating accounts. Both groups need to understand how to protect themselves, which this script explains. The real risk isn't the $10,000 report. A currency transaction report, CTR, by itself isn't an accusation. It's just paperwork, and most trigger nothing. The bigger risk is a different report called a suspicious activity report, SAR. Unlike the CTR, ASAR has no minimum threshold. It can be filed on a transaction of any size if the bank's software flags a pattern. The pattern that triggers this fastest. Several deposits that added together would have crossed $10,000. Anything that looks like it's designed to dodge the reporting rule. Diane's story. Diane, a 67-year-old retired nurse, sold her car for $11,000 in cash. Having heard that $10,000 was some kind of limit, she deposited $5,000 on Tuesday and $6,000 on Friday. Her money was completely legitimate, but the bank system flagged the pattern and filed a SAR. She was never told because banks are legally barred from disclosing SAR filings. Doing so is itself a federal crime known as tipping off. The biggest danger, structuring. Once people learn about the $10,000 threshold, their instinct is usually to split deposits into smaller amounts to avoid it. That instinct itself is a federal crime called structuring, 31 U.S. Code, Section 5324. Even if every dollar is completely legal, deliberately breaking it into smaller deposits to avoid a report is a criminal offense. Penalties up to 5 years in prison and $250,000 in fines for amounts under $100,000 within a year, up to 10 years for larger amounts or cases tied to other crimes. The government can also seize the money before any conviction, leaving the account holder to prove it was earned legally, often after the money is already gone. A federal review found that in the majority of cases where money was seized on structuring grounds, it turned out to be entirely legally earned money. Public backlash led to reform. In 2015, the IRS scaled back these seizures, and in 2019, Congress restricted the IRS from seizing legally sourced funds based on structuring suspicion alone. However, the Department of Justice can still pursue such cases, so the safest rule is simple. Never split a transaction to avoid the report. Why retirees get flagged more often. During working years, income usually follows one predictable pattern, a steady paycheck. In retirement, money often comes from multiple sources: Social Security, pensions, dividends, plus occasional lump sums like a home sale or inheritance. Automated banking systems are built to notice unusual variation, so a retiree's more varied financial life can draw more attention, even when everything is completely legitimate. A CTR doesn't mean an audit. It's worth remembering. A CTR filing on its own does not trigger an audit. It's simply a data point that only becomes relevant if another separate reason for suspicion already exists. The real protection: documentation. Sylvia, a 71-year-old retired school principal, inherited $38,000 from her late brother. She deposited the full amount in one transaction, brought the estate settlement letter with her, and asked the teller to note the source. A CTR was filed, but nothing ever came of it because she had the paperwork to explain it. Action steps for protecting yourself. Before depositing a large sum, gather proof of its source: a bill of sale, gift letter, estate letter, or pension notice. Deposit the full amount in a single transaction, never split it across days or branches. Hand the documentation to the teller and ask them to note it. Keep personal records of any transaction over $5,000. When moving your own money between accounts, do it as a single transfer with a clear memo explaining why. Never break a deposit or withdrawal into smaller pieces just to stay under $10,000. A large legitimate transaction is fine. Trying to dodge the report is what's dangerous. A few extra financial tips: keep only 1 to 2 months of expenses in checking, move the rest to a high-yield savings account or CDs, better returns, and a cleaner-looking account. If you're 73 or older and required to take minimum distributions, consider spreading them across the year instead of one lump sum in December. This is legitimate planning, not structuring. The annual gift tax exclusion is $19,000 per person for 2026. Larger gifts should be reported on Form 709, even if no tax is owed. A single high-income year from a property sale or big withdrawal can make more of your Social Security taxable and raise your Medicare premiums 2 years later. Spreading large income events across years can help avoid this. Payment apps like Venmo, PayPal, Zelle, and Cash App also generate their own records, so keep that activity organized too. Final thought: keeping cash at home isn't the solution. It's uninsured, vulnerable to theft or fire, and loses value over time. The real answer isn't to hide your money, but to keep it organized and documented. Your bank won't explain any of this to you, but now you know.